Most people lose money in stocks not because they pick bad companies, but because they make one critical behavioral mistake. The stock market has averaged 10% annual returns for over a century. Yet the average investor earns less than 4%. The gap isn't about knowledge or luck, it's about emotion, panic selling, chasing trends, trying to time the market. These behaviors destroy wealth faster than any bad stock pick ever could. Today, I'm exposing the psychological traps that cost investors tens of thousands, why they happen, and how to avoid them so your money actually grows. The behavior gap. Why investors underperform the market. Here's the data. The S&P 500 averaged about 10% annual returns from 1992 to 2022. During that same period, the average equity investor earned around 4%. That's a 6% gap. Over 30 years, that gap costs you hundreds of thousands of dollars. Why does this happen? Because humans are wired to react emotionally to money. We panic when markets drop. We chase performance when markets rally. We buy high and sell low, the exact opposite of what builds wealth. The market doesn't lose you money. Your behavior does. Mistake 1. Panic selling during market crashes. This is the #1 wealth killer. The market drops 20%. You see your portfolio shrink from 100,000 to 80,000. Panic sets in. You sell everything to cut your losses. Then the market recovers. It always does. But you're not in it anymore. You locked in your losses and missed the recovery. Real-world example. During the 2020 COVID crash, the market dropped 34% in a month. Investors panicked and sold. By August, the market had fully recovered. By the end of 2021, it was up over 50% from pre-crash highs. If you sold in March 2020, you missed one of the fastest recoveries in history. Why this happens? Loss aversion. Humans feel the pain of losses more intensely than the pleasure of gains. A 20% loss feels catastrophic, even though it's normal market volatility. How to avoid it? Expect crashes. They're not anomalies, they're part of investing. The market drops 20% or more every few years. If you're investing for 20 or 30 years, you'll live through multiple crashes. Don't check your portfolio daily. Set it and forget it. Automate contributions and let compounding work. For timeless investing principles that keep you disciplined through market volatility, read The Intelligent Investor by Benjamin Graham. It's the book Warren Buffett credits with shaping his philosophy. Links in the description. Mistake 2. Chasing hot stocks and trends. This is how people blow up their portfolios. You hear about a stock that doubled in 3 months. GameStop, Tesla, some random cryptocurrency. Your coworker made 10,000, your friend made 20,000. You feel like you're missing out. So you buy in right at the peak. Then it crashes and you lose 30 to 50%. Why this happens? FOMO, fear of missing out. You see others winning and assume the trend will continue. But by the time you hear about it, it's often too late. You're buying from people who got in early and are now cashing out. Real-world example, GameStop in January 2021. It went from $20 to $480 in weeks. People who bought at $400 lost 80% when it crashed back to $40. The ones who made money got in early and sold before the collapse. Everyone else got wrecked. How to avoid it? Stop chasing. Invest in boring, diversified index funds that track the entire market. You won't get rich overnight, but you won't lose your shirt either. If a stock has already doubled or tripled, you're not early, you're late. Move on. Mistake 3. Trying to time the market. Investors think they can predict market tops and bottoms. They sell when they think the market is about to crash and buy when they think it's about to rally. They're almost always wrong. Why this doesn't work? Nobody, not professionals, not algorithms, not you, can consistently predict short-term market movements. The market is influenced by millions of variables. Earnings, politics, global events, investor sentiment. It's chaos. Even if you're right once, you won't be right consistently. The cost of missing the best days. Studies show that if you miss just the 10 best days in the market over a 20-year period, your returns get cut in half. The problem? Those best days often happen right after the worst days. If you're out of the market waiting for the right time, you miss them. How to avoid it? Time in the market beats timing the market. Stay invested. Ride the ups and downs. Let compounding work over decades. For a deep dive into strategies that work for long-term investors, check out Money, Master the Game by Tony Robbins. Links in the description. Mistake 4. Overconfidence. After a win, you buy a stock. It goes up 20%. You feel like a genius. You think you've figured out the market, so you get bolder. You start making riskier bets. You put more money into speculative plays, then you lose, and you lose big. Why this happens? Overconfidence bias. A few wins make you think you're smarter than you are. You forget that luck played a role. You take on more risk than you can handle. Real-world example, day traders. Most make a few profitable trades early and assume they've cracked the code. Within a year, 90% of them lose money and quit. How to avoid it? Don't confuse luck with skill. If a stock goes up, it doesn't mean you're a genius. Markets are volatile. Sometimes you're right. Sometimes you're lucky. Stick to a disciplined, diversified strategy. Don't deviate based on short-term wins. Mistake 5. Holding losers too long. You buy a stock at $50. It drops to $30. You refuse to sell because you're waiting for it to come back. Meanwhile, it keeps dropping. You're down 60, 70, 80%. You're emotionally attached to the idea of breaking even, so you hold forever. Why this happens? Sunk cost fallacy. You've already lost money, so selling feels like admitting defeat. You hold, hoping for a recovery that may never come. Real-world example. People who bought stocks during the dot-com bubble and held them for 20 years, waiting for them to return to peak prices. Many never did. How to avoid it? Cut losers. If a stock is down significantly and the fundamentals haven't improved, sell and redeploy the money into something better. Don't let ego keep you in bad positions. Mistake 6. Not diversifying. You put all your money into one stock because you're confident it'll do well. Then the company has a bad quarter, gets sued, or faces competition. The stock crashes 50% and your entire portfolio gets wiped out. Why this happens? Overconfidence and lack of understanding of risk. People think they know more than they do. How to avoid it? Diversify. Own hundreds or thousands of stocks through index funds. If one company fails, it barely affects your portfolio. Never put more than 5 to 10% of your portfolio in a single stock. Mistake 7. Paying too much in fees. You invest through an actively managed fund that charges 1 to 2% annual fees. You think it's only 1%. Over 30 years, that 1% costs you hundreds of thousands in compounding. The math: you invest $100,000 at 10% annual returns with no fees. After 30 years, $1.74 million. You invest $100,000 at 10% minus 1% in fees, net 9%. After 30 years, $1.33 million. That 1% fee cost you over $400,000. How to avoid it? Invest in low-cost index funds. Vanguard, Fidelity, and Schwab offer funds with expense ratios under 0.1%. Keep more of your returns. The solution: build a system, not a strategy. Stop trying to outsmart the market. Build a system that works regardless of what the market does. Step 1. Automate contributions. Invest a fixed amount every month, no matter what. This is dollar cost averaging. You buy more shares when prices are low and fewer when prices are high. Step 2. Invest in diversified index funds. Own the whole market. S&P 500 index funds or total market index funds give you exposure to thousands of companies. Step 3. Ignore short-term noise. Don't check your portfolio daily. Don't react to headlines. Stay the course. Step 4. Rebalance annually. Once a year, rebalance your portfolio to maintain your target allocation. Sell winners, buy underperformers. This forces you to buy low and sell high. Step 5. Hold for decades. Investing is a long game. The longer you stay invested, the more compounding works in your favor. Your next move, if you're making any of these mistakes, fix them this week. If you're panic selling, stop checking your portfolio. Set up automatic contributions and let it run. If you're chasing hot stocks, sell them and move into index funds. If you're trying to time the market, admit you can't predict it and stay invested. The market rewards patience and discipline. It punishes emotion and ego. That's wealth mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.